Silver printed a high that had people chest thumping. Then it unraveled so fast that it felt like a trapdoor. Gold followed right behind it, and for a window of time, it was the kind of selling that makes you wonder if some giant player was forced to hit the eject button. But here's the hook inside the hook. The selling pressure is only half the story. The other half is what happened on the ground with coins, bars, inventories, spreads, and premiums. And when you connect those dots, you start to see a very different picture. So where do we go from here? Let's walk it down step by step. And stay with me, because the most important clue is not the headline price. It's the message hiding behind the price action. First, the hard numbers on silver. We saw silver run up into the low 120s, and then it dropped into the low 70s at the worst moment of the flush before snapping back into the mid 80s. That's not a normal pullback. That's a gut punch move that resets expectations and wipes out leverage. It also sets the stage for what comes next, because markets don't behave the same after they do something violent. On the day of the worst hit, silver's dollar drop was the biggest single-day nominal fall people can remember in this era. Now, percentage-wise, it wasn't the worst of all time. The record for percent pain still belongs to a historic episode decades ago when a highly concentrated speculative frenzy in silver finally got squeezed. Margin rules tightened and forced selling cascaded. That day, silver got cut in half. But here's the key difference. Back then, the dollar move looked smaller because the starting price was smaller. And that's exactly why this latest slide felt impossible to a lot of people. Now let me address something that's been floating around. You might have heard people calling this a 10 sigma type of event, like it's some once-in-a-lifetime of the universe mathematical glitch. I get why that's catchy. It sounds like the system broke, but I want to give you a more grounded way to interpret it. Because if you understand this, you'll stop being shocked by volatility and start reading it like a signal. Financial markets are not clean lab experiments. They don't follow tidy bell curves when there's leverage, margin, and forced liquidation involved. In real life, returns have fat tails. Big moves cluster. When one big player or a chain of players gets hit with margin calls, the math changes because it's no longer a normal market. It becomes a liquidation machine. That doesn't mean it's fair. It means it's a structure problem, and structure problems create headline moves. So instead of asking, how could this happen? The smarter question is what had to be true for this to happen. And that question takes us straight to the most suspicious detail of the entire sell-off: circuit breakers. A lot of people noticed that as metals were sliding, the normal breaks that should slow trading didn't seem to catch the move the way you'd expect, and that set off a wave of speculation. Was the exchange ignoring its own limits, or did the market simply not hit the specific conditions that trigger a halt? Here's what's real. Futures markets can have daily price limits and different rules by product and session, and those limits can shift depending on the contract in the day. Now, that doesn't answer the emotional part, the why did it feel like there were no guardrails part, because what people felt was this: when price is ripping upward, liquidity can vanish, and when price is dumping, liquidity can vanish too. But on the way down, it often feels like the system is happy to let it fall because forced selling is orderly to the people who care about clearing. That's the uncomfortable truth. The market's plumbing is designed to survive, not to protect your feelings. And if you're wondering why I'm drilling into this, it's because this exact dynamic is what separates paper price from physical reality. And we're going to that next. Before we do, one thing you must keep in mind. Even after the beatdown, silver is still up compared to where it started earlier in the cycle. That tells you something important. It clears throat, tells you the long-term pressure hasn't magically vanished. It tells you this move might be a reset, not a funeral. Now here's where it gets interesting. While the screen price was crashing, the physical market was sending the opposite message. Multiple dealers were describing a surge in people trying to lock in metal, especially silver, because they saw the drop as a rare chance to get in before premiums expand again. And some large mints and wholesalers were basically saying, "You're not ready for what's coming," describing demand interest that reminded them of the chaos during the lockdown era. This is where you need to pause and ask, if silver is collapsing, why are people trying to buy it like it's disappearing? That contradiction is the entire game, because paper can move instantly, physical moves slowly. And when paper price collapses faster than physical supply can respond, the gap shows up in one place: premiums and spreads. And there's another clue that's even louder: regional pricing. From recent market updates, silver in Shanghai has been trading at a meaningful premium to Western benchmarks, and the premium widened as demand spiked. Let me translate what that means in plain English. If you can buy something for one price in one part of the world and its price significantly higher somewhere else, that is not a fun fact. That is the market screaming that supply is tight, logistics are constrained, and local demand is paying up to secure metal now, not later. Now, do I want you to assume every premium is pure scarcity? No. Premiums can include taxes, import costs, shipping, financing, purity differences, and local market frictions. But when the premium balloons and sticks, it still tells you one thing: the real metal is not flowing effortlessly to meet demand. And this is where a lot of people get it wrong. They think if there's a premium in one place, someone will just arbitrage it away. In theory, yes. In practice, arbitrage is limited by regulation, transport, time, and available inventory. And when the market is stressed, those constraints become walls. So when you hear silver is $40 higher over there, don't just treat it as gossip. Treat it as a stress test result. Now, let's talk about the big question. Is this sell-off a healthy correction, or is it a warning shot? Here's my take, and I'm going to keep it honest. A correction after a parabolic move is normal. It's almost required. Markets don't go straight up in a clean line unless there's some external price control, and even then, they eventually gap. The faster something rises, the more leverage accumulates, and the more fragile the move becomes. So yes, the sell-off can be a reset. But there's a second possibility, and this is the one that should keep you watching. The sell-off can also be a hunt for liquidity. And when a market is hunted for liquidity, the decline doesn't stop at reasonable levels. It stops when enough forced sellers are wiped out and enough buyers step in with size. That means the bottom isn't set by logic, it's set by pain. And that's why this matters, because if what we just saw was a forced liquidation event, then the rebound can be violent in the other direction once the forced selling is done. And the people who sold in panic become the people chasing later. So what should you watch now? You watch whether physical premiums expand, you watch whether delivery times stretch, you watch whether futures spreads behave oddly, you watch whether the gap between regions narrows or widens, and you watch whether volatility stays elevated, because high volatility tells you the market is still unstable. And here's another angle that helps explain why it felt like the market didn't make sense. Most people watch the spot chart and assume that's the whole market, but the spot chart is really a reflection of multiple layers: futures positioning, options hedging, dealer inventory management, and sometimes pure mechanical selling when risk desks hit their limits. When volatility spikes, margin requirements can effectively rise even if the official rules don't change because brokers tighten risk. Clearing firms demand more collateral, and anyone who is overextended suddenly has to come up with cash fast. That's when you see the weirdest behavior. Perfectly rational long-term holders don't want to sell, but leverage players have no choice. They sell the most liquid thing they own, and in metals, that often means futures. That's also why the physical market can be screaming tight at the same time the paper market is dumping. The futures market can clear in seconds. The physical market clears in trucks, vaults, and refinery schedules. Different speed, different rules. Here's a practical example. If you're trying to buy common retail products, 1-0s rounds, small bars, government-minted coins, the supply chain has bottlenecks. Blanks have to be sourced, fabrication capacity is limited, and shipping has constraints. When everyone shows up at the same time, the first thing that happens is not the world runs out of silver. The first thing that happens is the easy-to-move inventory gets snapped up, and the premium rises to slow demand. That's why you can have a day where the screen price is down hard, yet your checkout card is more expensive than it was the week before. And it's not just retail. In stressed moments, you can see tightness show up in the way metal is borrowed and lent behind the scenes. Lease rates can lift, spreads can act jumpy, and the market starts paying a higher price for metal now versus metal later. You don't need to be a professional to understand what that implies. Urgency. Now zoom out one more step, because this crash didn't happen in a vacuum. When a big move hits, exchanges and brokers respond in different ways. We even saw some markets put temporary limits on how wildly metal-related exchange-traded products could swing in a single session after the breakdown, basically forcing a cooling-off period for retail wrappers, even while the underlying metal was still chaotic. That tells you regulators and exchanges know volatility can turn into a confidence problem. And when confidence becomes the issue, the next move can be even sharper, either direction. So if you felt whiplash, you're not weak. You're just watching a market go through a stress event. And here's the cliffhanger inside that. Stress events often create the best information. They reveal where the real demand is hiding, and they expose which parts of the system are fragile. Now, I'm not here to tell you to buy now or sell now. I'm here to tell you what the chessboard looks like. And speaking of the chessboard, there's a bigger thing happening underneath gold and silver that most people aren't connecting. Industrial metals, copper. Because while everyone is staring at the precious metals drama, copper is sitting there like a coiled spring. And if copper decides to run, it changes the inflation conversation, it changes the manufacturing conversation, and it changes the hard asset conversation. Here's the big idea that keeps coming up in recently published numbers and industry studies. The world is trying to electrify everything, and copper is the wiring inside that future. Demand projections out to the early 40s are massive, with some forecasts pointing to annual demand rising from around the high 20s of millions of metric tons today to the low 40s by that horizon, and a supply gap that could leave a meaningful chunk of demand unmet without major new investment. That's not a small mismatch. That's a structural problem. Now, to be clear, forecasts are not guarantees. Demand can be delayed, substitution can happen, recession can hit, projects can get canceled. But let me give you the reason copper keeps coming back to the center of the story. Even if the world slows down, the infrastructure build-out doesn't stop. Data centers still get built, grids still get upgraded, defense systems still get modernized, energy transition projects still move forward. Sometimes slower, sometimes faster, but they don't vanish. And here's a fresh data point that matters. Major miners reported that copper output has been pressured by declining grades and operational constraints, even as long-term demand expectations keep climbing. So you've got this weird two-off war. Supply growth is hard, demand growth is sticky, and price becomes the pressure valve. Now let's bring that back to gold and silver, because there's a reason I'm pairing these. When the market gets hit with a sudden liquidation, everything can drop together at first. Gold, silver, copper, whatever. If it's liquid and held with leverage, it can get sold. That's the sell what you can phase. But the rebound phase is where you see the truth. The rebound phase shows you what people actually want to own. And that's why the physical demand story matters so much. Because if the sell-off was paper-driven and the physical market stays tight, then the screen price can snap back and the premiums can stay elevated. That creates a weird feeling where people say price dropped, but it's not actually cheaper to buy. Have you ever seen that before? It's confusing the first time, but it's a pattern. Now, I want to add one more layer of context that wasn't in the competitor script, because this is where the new info becomes real. Silver isn't just a shiny metal people hoard. It's also a critical industrial input. In recent years, industrial demand has been a huge slice of total usage, and the market has been running deficits, meaning demand has been higher than supply multiple years in a row. That matters because deficits don't always show up instantly in price. Deficits can be masked by inventories, recycling, and financial flows. But over time, sustained deficits tighten the system. And when the system tightens, it doesn't take much. One strong wave of retail buying, one supply hiccup, one surge in industrial demand for the whole market to feel like it's short metal. That's why people obsess over, is silver going to be sold out? Now, let me be skeptical for a second. The phrase sold out everywhere by tonight makes for a viral quote. It's dramatic. It's also not always literally true because there are always layers of inventory. Some public, some private, some locked into different forms, some priced so high nobody wants it, some reserved for industrial users. So instead of taking that claim at face value, here's the smarter way to interpret it. When people say sold out, they often mean the popular products are gone, the backlog is growing, and premiums are rising. They mean the easy supply is gone, and that can happen even when the total global silver inventory is not zero. So don't get hypnotized by the drama. Watch the practical signs, product availability, wait times, and premiums. And if you're successful, share your success story in the comments so others can stay motivated. Seriously, someone reading your comment might need that push. Now, let's get back to the price action because this is where the next cliffhanger sits. We saw the dump, we saw the bounce. The question is that bounce the start of a new leg up, or is it a dead cat bounce before the next wave down? And the answer depends on one thing, whether the market can stabilize without crushing demand. If silver stabilizes and demand stays hot, you get a base. If silver keeps whipping around and premiums keep climbing, you get stress. And if you get stress, you can get another spike that shocks people who thought the story ended with the crash. That's the part I want you ready for because the market loves to punish certainty. Now, gold. Gold had its own ugly moment. The drop on gold was not as extreme as silver in percentage terms, but it was still a big move for a metal that's usually treated like the calm adult in the room. And when gold moves like that, it tells you that liquidation was broad, not isolated. But gold also has a different engine than silver. Silver is part monetary, part industrial. Gold is primarily monetary and reserve driven. That means when gold gets hit, it's often about dollars, yields, and positioning. So when gold drops hard and then steadies, I start watching currency dynamics and real rates. Because if the market starts pricing easier policy or weaker purchasing power, gold has a way of reasserting itself. Now, I'm going to say something that might annoy both sides. Bulls want every drop to be manipulation. Bears want every spike to be a bubble. Reality is messier. Yes, large players influence liquidity. Yes, derivatives amplify moves. Yes, narratives get pushed when it benefits somebody. But the deeper truth is that markets are complex, and the same move can have multiple causes. A drop can be liquidation plus profit taking, plus risk off-selling, plus a stronger dollar intraday. And that's why simplistic explanations fail. So what's the actionable insight? It's this. In a high volatility environment, you can't just watch the price. You have to watch the transmission mechanism. What's pushing price? What's pulling it? What's breaking? And the transmission mechanism right now includes physical tightness signals and industrial demand signals. Now let's talk about something that's going to matter this week: psychology. After a crash, the crowd splits into three groups. Group 1 is traumatized. They say, never again, and they swear off metals. Group 2 is euphoric. They say this is the dip of the decade, and they go Allen. Group 3 is patient. They say, let the market show me. The people who survive long-term usually live in Group 3. So, if you're watching this and your heart rate is up, here's what I'd tell you as a friend. Slow down. Decide what your time horizon is. Decide what you actually own. Paper exposure or physical metal. Decide what your goal is. Trading, hedging, or long-term wealth defense. Because the same market move means different things depending on your goal. Now, there's one more thread we need to pull, and it's the thread that links the metal's crash to the bigger economy: liquidity and confidence. When assets drop sharply, people look for what's stable. Some run to cash, some run to bonds, some run to metals, some run to energy and resources. And right now, the reason metals keep snapping back is because the bigger backdrop is still unstable. Debt loads are high, fiscal deficits are persistent, and when the public sees that, the appetite for real things doesn't disappear, it just moves around. That's why you can have a crash and a buying frenzy at the same time. Different players are doing different things. Now, let me briefly mention something important. The description includes bonus links. There's a premium WhatsApp channel link if you want quick updates, and there's also a channel membership join link if you want to support the work and unlock extra material. And speaking of memberships, we also offer members-only videos that are produced by a separate team with more research and more depth. Those are only for premium members, and they go into the stuff we can't always fit into these main videos without slowing the pacing. All right, back to the story because I promised you the part most people aren't talking about. The rebound. Silver bounced from the low 7s back into the mid 80s. That's a huge move in a short time. But here's what matters. Rebounds like that often create a trap. Why? Because after a violent drop, the first bounce can be fueled by short covering and bargain hunters. It feels good. It feels like relief. It makes people think the danger passed. Then the market tests the lows again. Sometimes it holds, sometimes it breaks. And the second test is where you learn whether the market is healthy or fragile. So this week, what I'm watching is not whether silver has a green day. I'm watching whether the market can handle selling without collapsing again. If it can, you get a base. If it can't, you get a second wave that punishes anyone who bought too aggressively. And that's why the next few sessions could be, let's just say, educational. Now, I also want to address the bigger trend still intact claim because you've probably heard that phrase. I think it can be true, but only under certain conditions. If the fundamentals are tight, deficits, industrial demand, constrained mine supply, then yes, the long-term trend can remain constructive even after a crash. But if the market is being driven mostly by speculative mania, then a crash can be the beginning of a long cooling off period. So what was driving this? In my view, it was both. You had real tightness in the physical market and strong demand narratives, but you also had speculative heat and leverage. When leverage gets flushed, it doesn't mean the story is over. It means the story changes. And that leads to the next cliffhanger. What if the flush actually sets up the next rally by removing the weak hands? That's how bull markets often work. They scare people out right before the next leg. Now let's pivot back to copper for a second because copper gives you a map for how resource markets behave. Copper has been in a situation where the long-term need is enormous, but supply expansion is slow, expensive, and politically complicated. You can't just snap your fingers and open a mine. Permits take time, capital takes time, community support takes time, infrastructure takes time, and we're seeing big players talk about supply gaps into the future, partly driven by electrification and data centers. So when copper sells off with everything else, I don't automatically assume the copper story is broken. I assume it's temporarily risk-off. Now, in the competitor script, there was a hard pivot into promoting a specific small company. We're not doing that here. Instead, I want to give you a practical framework for evaluating any resource company you see people pumping. Ask 3 questions. 1, is the asset real or is it a story? 2, does the company have a path to money, either cash flow, financing, or a credible partner? 3, is the valuation pricing perfection or is it pricing survival? If you can't answer those, you're not investing, you're hoping. And hope is not a strategy. Now, let's bring it back to gold and silver one more time because we're heading into the final stretch, and I want to land this with clarity. Here's what we know. We saw a violent sell-off. We saw a sharp rebound. We saw signs of physical interest. We saw regional premiums signaling stress. We saw the broader resource theme still alive, especially in copper demand forecasts. Now, here's what we don't know. We don't know whether the market will retest the lows. We don't know whether more forced selling is waiting in the shadows. We don't know whether the next catalyst is bullish or bearish, but we can prepare by watching the right signals. Signal 1, premium behavior. If premiums rise while price falls, that's a tightness signal. Signal 2, delivery times. If delivery times stretch, that's a supply friction signal. Signal 3, spreads. If spot tightness shows up in lease rates or future structure, that's a metal now signal. Signal 4, regional pricing. If Shanghai keeps paying up relative to Western benchmarks, that's demand concentration showing itself. Signal 5, broader risk appetite. If equities and credit markets wobble, forced selling can spill into metals again. Now I want to talk directly to the person who's feeling nervous. If you're holding metal and you just watched a huge drop, your brain is screaming at you to do something. That's normal. But the best moves are often made when you're calm, not when you're scared. So ask yourself, did your reason for owning metals change? If you own metals as a hedge against currency debasement and systemic risk, one ugly week doesn't erase that logic. If you own metals as a trade, then your rules matter, your stops matter, your risk sizing matters. Different goals, different decisions. Now, second engagement moment. If you're successful, share your success story in the comments so others can stay motivated. I mean it. People need to hear what works. And while you're down there, I want to ask you 2 questions. Do you think this crash was mostly forced liquidation, or do you think it was the start of a longer unwind? And second, when you look at silver's premium overseas, do you see that as real scarcity or just temporary friction that will fade?